What's up you guys, this is Ashmeet and welcome to my channel Litpreneur. In today's video we will be discussing about the basics of candlestick and some single candlestick patterns. Hope you like this video and do give your feedback in the comment section below. So guys, before we move to different types and patterns of candlesticks, we will discuss the different parts of it and their implications. There are basically two parts of a candle, a body and the shadows. Shadows are also sometimes commonly referred as wicks. Now, the black rectangular mass in the slide is the body of a candle, while the two thin lines above and below the body are the shadows. The tip of the upper shadow is the high price point and the lower shadow connects the body to the lower price point. Now moving on to the types of candles, we have a bullish and a bearish candle. By bullish candle we mean that on the day this candle appeared, the share price closed higher than its opening price, indicating strong buying activity. While in the case of a bearish candle, the opening price was higher than the closing price and represents a strong selling activity. In order to understand this better, let us take them up individually. In the bullish candle, the upper shadow connects the high price point to the closing point, while the lower shadow connects the low price point to the opening price. For your understanding, the price points are given and plotted on the candle beside as an example. Now on the bearish candle, the upper shadow connects the high price point to the opening point, while the lower shadow connects the low price point to the closing price. Here also, for your understanding, the price points are given and plotted on the candle beside as an example. In addition to this, remember that both the open and close prices lies at either edges of the body, which varies according to the candle. So guys, as we are done with the introduction of candlesticks, from here onwards we will start with the single candlestick patterns, and these are the few patterns that we will be discussing in our video. However, before I discuss each of these patterns with you, there are a few things that I want you all to remember. The first fact to keep in mind is that buy strengths and sell weaknesses. By this I mean that buying should be done on a green candle day, while the selling on a red candle. Bullish candle represents strength and probable buying activity, implying rise in share price due to the demand. However, bearish candle represents weakness and the selling activity imply fall in the share price. The next rule is to be flexible with patterns. As there will be variation between the actual patterns in a chart and a textbook, therefore we need to be flexible within certain limits. As the complete structure of technical analysis is based on the thesis that history tends to repeat itself, we move on to the third fact that makes us focus on the prior trends. With this we come to the last point, that is to look for the size of the candle, as it signifies the range of the stock on that particular day. The longer the candle, the more intense is the trading activity. And now, as I believe that you will remember all these points, let's move on to our first candlestick pattern, that is Marubozu candle. Marubozu is a Japanese word which means bald or shaved head. Therefore this candle does not have any shadows and just have a real body. These candles are of two types and can appear anywhere in the chart, predicting the price points and direction of the stock. In a bullish Marubozu, due to the absence of shadows, the opening price is equal to the low while the closing price equals the high. This implies the buying interest or activity in the stock is so high that the market participants bought the stock at every price point. Also, the prior trend on a Marubozu date doesn't matter, as the price action on the given day indicates the market sentiment for next few trading sessions, which in this case is bullish, and traders should look to buy the stock around the closing price. Let's understand this better through an example. On your screen there is a day chart of a stock and a Marubozu candle is encircled in it. The open, high, low and close prices are also provided. Now a doubt that would occur here is that the opening price is not equal to the low and closing price doesn't equals the high, while the definition stated otherwise. So here comes the fact of being flexible into the action. The percentage of variation is negligible, hence we consider it a Marubozu candle. Thus, the trade setup for this candle would be to buy the stock around the closing price, that is 921, with the stop loss at low around 904. Now as we are done with the bullish Marubozu, let's discuss the bearish Marubozu. In a bearish Marubozu, the open price equals the high, while the closing price is equal to the low price point. This implies the selling interest or activity in stock is so high that market participants sold the stock at every price point, and market sentiment is probable to be bearish for the next few trading sessions. Let us understand this with the help of an example. We have a day chart here and a bearish Marubozu is indicated. The price points are also provided for which the trade setup would be to short the stock around low or closing price, that is 928, while the stop loss would be around the high or opening price of 948. With this we have completed the Marubozu pattern and will move on to the spinning tops now. Spinning tops have a small real body with the upper and lower shadows being almost equal. These candles do not provide a specific entry point and indicate uncertainty and indecisiveness in the market. To understand the implications of a spinning top, let's dissect it into three parts. The small body implies that the difference between the opening and closing price is very low. Hence the color of a candle doesn't make much difference. The upper shadow connects the high point to the real body, and if for the moment we forget about the lower shadow, we may perceive that bulls tried to take the market higher, but were unsuccessful in their attempts, cause if they would be successful, we might be witnessing a long bullish candle. The last part is the lower shadow, which connects the low price point to the body. Here if we proceed with a similar process as in the upper shadow, we may conclude that the bears tried to take the market lower, but failed eventually. As if they would have been successful, we might be having a long bearish candle at our disposal. Now taking up the candle as a whole, a spinning top does not convey much. As both the bulls and bears failed to influence the markets, the sentiment positions to be uncertain. The next pattern that we will discuss is the doji. The doji is very similar to the spinning top, but unlike it, the doji does not have any real body, which means that a doji is formed when the opening and closing prices are equal. We will not go much in detail with the doji as the concepts of the spinning top applies to it as well. Let's move on to our next pattern, that is the paper umbrella. The paper umbrella is a single candlestick pattern characterized by small real body with the longer lower shadow. We interpret the paper umbrella by where it appears on the chart. It helps the traders to set up directional trades and consists of two trend reversal patterns, that are the hammer and the hanging man respectively. We will discuss these two in detail, but before that let's understand the only condition required for a candle to qualify as a paper umbrella. The lower shadow must be at least twice the length of the body, or we may say that the shadow to real body ratio must be equal or greater than 2. We can learn to calculate the length of the shadow through this example, where the OHLC price points are given. To calculate the length of the body, we subtract the opening price from the closing price, that is 2, and for the length of the shadow, we subtract the low price from the opening price, that is 6 in this case. Hence, as the shadow is more than twice, this candle is a paper umbrella. Now before we move on to discuss the next patterns in this video, keep in mind that whenever the body of a candle is small, the color of a candle doesn't matter much, as the price difference between the opening and closing price is very less. Now let us move forward and discuss the hammer pattern. The paper umbrella appearing at the bottom of a downward rally is categorized as the hammer and is bullish in nature. The concept behind the hammer is that the bears were in control of the markets in a downtrend and markets were making new lows until a hammer appeared. At the day hammer appeared, there was some buying activity which pushed the closing price higher, preventing markets to close at new low. This buying activity represents the entry of bulls and probable bullish movements in the market. Hence a hammer formation suggests a long trade. We have a chart here where a hammer is encircled. Ensuring that prior trend is bearish, the trade setup according to hammer would be to buy around the closing price, that is 712, with a stop loss of low at 692. This brings us to the completion of the hammer, and we will discuss the hanging man now. The hanging man is a paper umbrella which appears in an uptrend and is bearish in nature. The logic behind the hanging man is that in an uptrend, the bulls were in control of the markets, while markets were making new highs. With the appearance of a hanging man and its long lower shadow, the bears managed to make an entry in the market and tried to break the stronghold of the bulls. Hence, a hanging man suggests to go short on a stock. Now in the chart we have here, the uptrend is marked while the hanging man is encircled. The trade setup according to this hanging man candle with the given price points would be to sell or short the stock at 8.2 and place stop loss at 8.3. With this we come to the last pattern in our video, that is the shooting star. It is characterized by long upper shadow and small real body, where the length of the shadow is at least twice the body. A shooting stars appear in an uptrend and is bearish in nature. Also keep in mind that longer the shadow, more bearish is the pattern. Well, let's understand the logic behind it. In an uptrend, the bulls were in control of the market and the stock was making new highs. However, on the day of shooting star at around the high price point, the stock faced high selling pressure and closed near the low price point of the day. This marks the entry of bears and their successful attempt at taking down the market, hence creating an opportunity for a trader to short the stock. The OHLC price points on the chart here would suggest a trader to short the stock around the low price point, that is 755 in this case, with a stop loss at high of 758. Now guys, if you liked this video and want to open your demat and trading account, you can open it through the link in the description or in the cards.